Hello, all. We'll be starting the meeting in another 5 minutes, so brace yourself to seats. Thank you. Hello, all. Thank you for joining us today. Hope you all had an amazing lunch. Today, we will be having us.
The product, I wanted to share something about how we look at cycles in the market and how we go about constructing our portfolio. Because understanding cycles is very important in the journey of investing. It'll help you compound your money better than the market. So why are cycles important in the markets? Because companies rarely make money in isolation. It is always together. They make money together. For example, in the year 2000, it was all the IT companies. It was the tech boom. If you had bought Infosys in 1999, your investment would have become 10x in just 1 year. Think about it. And in the year 2007, it was all capital goods, infrastructure, power. It was the infra boom. And in 2015, it was pharma companies. And in 2019, it was financials. And in 2021, it was IT again, right? So companies in a sector make money together. And hence, it is important to understand these cycles. So, how do we get a sense of these cycles? One indicator is the Nifty 50's component weights, as in what is the weight of each sector within the Nifty 50. Nifty 50 is the leading index of our country. It's the top 50 companies based on free float market capitalization. And based on the market cycles, the weight of each sector within the Nifty 50 differs. We'll see one by one. Like we already saw that in 2007, it was the infra boom. But in 2005, construction had only a weight of only 1.8% in the index. But fast forward to 2009, it had a weight of almost 4%. And look at power and energy, it had a weight of 40%, right, from 26%. So that's how cycles and within cycles, the sectors move. Uh, and 2009 was the perfect time to exit these stocks and move to, say, something like automobile or FMCG or even financial services. Because if you look at automobile, their weight increased from 3.3% in 2009 to almost 9.9% in 2015. Of course, the way Nifty 50 weights are calculated changed in 2010, but even otherwise, automobile was a sector to be in at the bottom of the cycle in 2009. And look at pharma. In 2009, the weight of pharma was only 2.5%, and it went up to almost 7.3% at the peak of its cycle. Even today, Sun Pharma is below its, or it just reached its market capitalization that it had in 2015. So it took 8 years for Sun Pharma to come back to its original peak levels. So that's how cycles move. And to illustrate this, the cycles further, let's go through a few examples to understand better. So since the inception of Nifty 50, 12 companies have been part of it. The rest of the companies have been moving in and out of Nifty 50. And these are well-known, reputed big names in our country, right? Reliance, HDFC Bank, the Tata Twins, ICICI Bank. But do you need them in your portfolio all the time, right? So we look at the cycles across since 1993 and how we'll take two examples, one L&T, two HUL, both well-known names. But between the cycle from 1993 to 2000, which is a 7-year cycle, L&T degrew, the stock price of L&T degrew every year. The CAGR was minus 1%, right? And HUL, it went up 5.6 times. If had you invested 100 rupees in HUL in 1993, you would have made 28% annual returns every year. Had you invested in the index, you would have made only 3% every year. So this is how cycles work. Extending the cycle further to the next 8-year cycle from 2000 to 2008, L&T went up almost 9 to 10 times. From 90, your investment from 90 would have become 860 at the end of the bull cycle in 2008. So that was a CAGR of 33%, whereas HUL returned only 2% every year. Index gave you only 12% returns every year. And then moving this cycle forward to 2019, which was just before COVID happened, the 11-year cycle, L&T gave only 10% returns, whereas HUL gave 23% returns, and the index was somewhere in between. So you get the hang of cycle, right? In markets, stocks move together, stocks in a sector move together, and the sector itself is different in every cycle. And the cycle could be different. It could be a 7-year cycle, 8-year cycle, and then a 11-year cycle. What if instead of having one stock, had you switched between stocks across cycles, let's say between 1993 to 2000, had you invested only in HUL, your money would have given you 28% returns, your investments. And in the next 8-year cycle, instead of staying in HUL, had you switched to LNT, then your returns would have been 33%. And then again, if you had switched back to HUL in the third cycle, your returns would have compounded much better than LNT only or HUL only, or definitely better than the index only returns. Now, don't get excited looking at the 27% CAGR. This is just for representation purposes and to explain cycles, right? So that was Nifty 50's sectoral weights amongst different sectors. Another way to identify cycles is to monitor the share of profit pools amongst all sectors. Right at the peak of the last cycle, you can see that the industrial sector had, of all 1,000 companies, industrial sector had the biggest share of profits, almost 55% at the peak in 2005. That has gone down from 55% to as low as 35-40% in somewhere in 2015, 2016. So clearly, industrials weren't making money, or they weren't making as much money as the other two buckets, which is financial services and consumption. So this is another way to identify cycles, where the money is moving, who's making money. That's how you look at cycles. So what lessons have we learned from these market cycles? So history does point out to long periods of underperformance of any favorite sector. Like if a sector is assumed to be a favorite, if that's the consensus that the market thinks, all the investors in the market think, then that will certainly underperform going forward. In the medium term, they will outperform the index, but long term, they might underperform, right? You have to differentiate between good companies and good stocks. HUL is a very good company. We use almost all of its products in our homes, but is it a good stock? That answer depends on which part of the cycle we are in. One leading indicator is valuations, right? You can anticipate upcoming cycles based on the valuation of each of these sectors. So it is important to capture the cycles of investing. So where are we in the cycle right now? So if you look at March 2023, IT is at a weight of 13%, which is its historical low post 2009. So that's in 14 years time frame. This is the lowest that IT has ever been, contributing to the Nifty 50 weights. And go back to 2021, it was automobile and construction companies, right? So you should have bought automobile stocks in 2021. Because of COVID, cars weren't selling, so companies weren't making money, their market caps fell, and their weights in the Nifty 50 fell. So you should be buying automobile in 2021, you should be buying IT now. That's how you should look at these cycles. So what is the ithought way? What is our investment philosophy? We have a very long-term focus. We don't look at 1 year, 2 year, 3 year. I mean, we're talking about 7-year, 8-year cycles. So that's the kind of focus we have. It's very long-term and non-consistent investing. If everybody thinks that a stock will do well, if we are already holding it, we'll be looking at when to exit rather than should we be buying more. So that's non-consensus investing. And bottom-up approach, we give merit to companies' fundamentals and the sector it operates in rather than what the entire economy is doing. So that's bottom-up approach. High focus on risk management. We look at corporate governance, we look at leverage. We'll go through it one by one in detail. So within ithought ecosystem, Trublu portfolio is a large cap portfolio where we try to capture mega trends of both India growth story, which is our domestic story, and we also capture the global growth story through our global champions. So what is the USP of Trublu? It's a pure 100% large cap product, and we have a very high active share. What do I mean by high active share? Let's say a stock has a weight of 5% in Nifty 50. We might even not have that stock, or we'll have a different weight than the 5% that Nifty 50 has allocated for it. And we have a very low churn. We don't keep trading. We don't move in and out of stocks. We try to buy and hold stocks for the longest time possible till the cycle plays out. And we have zero fixed fees. It's related to the performance of your investments. So what makes a great investment? It's strong fundamentals and attractive valuations. So there are six metrics for uh, having a great investment. One is good corporate governance, the board of directors, the management, the promoters, how have they behaved in the past? And strong leadership teams with track record of execution. How have they executed in the past? And are these companies industry leaders in the segments that they operate in? And do they have very high profitability, which is measured through ROCE, return on capital employed? And do they put up capacities, or do they spend using equity capital, or do they borrow and take high leverage to do their business? So we prefer companies with zero or very low leverage. Leverage is measured in terms of debt to equity. And finally, which is the most important, I would say, of these, is reasonable valuations. So what are the key portfolio quants of the Trublu product? We look at it from four pillars, which is portfolio construction, quality, profitability, and growth. So when we designed this product, we looked at it from a perspective of first principles, like why should the index have 50 stocks, right? And why should it be free float market cap based index? And so those were the questions that we asked before we designed this product. So we have only 20 stocks in our portfolio right now. And even those 20 stocks have been designed or constructed in a way that they have very low earnings variability. For example, Nifty IT's variability is only 6%, which means in any year, the worst case fall in a Nifty's IT stock's earnings will only be 6%. From 100 rupees, it will go down to 94. Whereas for energy, it is as high as 39%. Some companies in the energy sector can even lose 40% of their earnings in 1 year. That's how volatile the earnings are between amongst these sectors. So we tend to stick with low variability sectors, which is IT, auto, FMCG, and banks, and to pharma to some extent. So active investing the true blue way. So if you look at Nifty 50's construction, the top five stocks, so the bottom 10 stocks contribute 26% weight in our product, whereas it's only 6%. So that's the difference, significant difference between our product versus the Nifty 50. And even within the top five, top 10, or the bottom five, bottom, there'll be significant difference. For example, Nifty 50's top weighted stock is Reliance, whereas we don't have it in our portfolio. And even Axis Bank, we don't have it yet in our portfolio. Another example is Infosys has a higher weight in Nifty 50 because the free float of Infosys is very high. But if you look at in terms of market cap, TCS is almost 2x or more, twice the market cap of Infosys. So ideally, a stock like TCS should have a higher weight, and even better, we have another IT stock, HCL, which has a higher weight than both Infosys and TCS. We look at it in the subsequent slides. So the balance sheet quality of our True Blue stocks, if you look at a ROE, which is how we measure profitability and the quality of balance sheet, it's higher than for all the companies. It's higher than the cost of capital, which is if you consider 7 to 8% as your cost of capital, the returns that these companies are making is significantly higher. Some do 2x, some do 3x. IT companies even make 4x of the cost of capital. And most of them have very low debt to equity, or they don't even have any debt on their balance sheet. So in TrueBlue, we have 21 stocks. Out of the Nifty 500 universe, which is 500 stocks, the top 500 stocks in the country, 21 is just 4%. But this 4% of stocks is contributing almost 26% of the profit of the entire Nifty 50. The rest of the stocks, which is almost 480 stocks, contribute only 74% of the profits of the entire Nifty 500 universe. If you had to rank the profits made by these companies across time periods, in this case, compare the rankings in 2012 versus 2022, which is a 10-year period. If you look at our stocks and the stocks in our portfolio, they have grown significantly in their profit ranking. For example, HDFC Bank in 2012 was the 13th largest profit company in the Nifty 500 universe. Whereas in 2022, it has jumped to fifth place. Same with HDFC from 19 to 16. And if you look at a company like HCL, which is where we are very bullish on, it's gone from 39th rank to 20th rank, which means they've been gaining market share. They've been making more money than the rest of the other Nifty 500 stocks. Not just these companies. If you look at the go through the entire list of our stocks, they have improved. Most of them have improved their ranking compared to 10 years uh, ago. So till now we were looking at the portfolio as a whole. Now we look at the individual stocks in our portfolio. We'll begin with our the largest stock in our portfolio, which is HDFC Bank. If you look at the intrinsic HDFC Bank, which is measured using book value, all banks will have a book value. So that has compounded at a rate of 21% in the last 10 years. And the share price of HDFC Bank has compounded at a rate of 17% CAGR in the last 10 years. So if, let's say, HDFC Bank has a weight of 8% in the Nifty 50 index, shouldn't we be having a higher weight in our portfolios because it is compounding at a higher rate than Nifty 50, than Nifty 500, than most of the stocks in the Nifty 50 universe, right? So that's our thinking. And HDFC Bank is an execution machine. I mean, uh, so for example, one example is if you look at the financial year profits, the full financial year profits of HDFC Bank, they'll match that full year profits in a single quarter 7 years down the line. For example, in 2016, whatever the earnings were in 2016 full year, they made it in a single quarter in FY23, which means they double their profits every 3 to 4 years. That's how you get this compounding of 18%, 17 to 18% for HDFC Bank. What makes HDFC Bank special and why do we have it as the top weight? Because if India's loan growth is 10%, the entire country has borrowed 10% more than what they borrowed in the previous year, HDFC Bank would have grown their loan book at 1.5 to 2 times of India's credit growth. So HDFC Bank would have either grown at 15 to 20%, depending on which cycle we are in. So that's the multiplier that HDFC Bank has over India's growth story. Right now, credit growth has been weak in the last few years for the country as a whole. Like we are doing only 12 to 15% in the last 2 years. And that's the reason, the big reason for that is because corporate debt as a percentage of GDP has come down from the peak of 62% to 50%, which means in the previous capex cycles, every company put up capex capacities, they expanded left, right, and center. They took leverage, they borrowed money from banks to put those capacities. And in the subsequent cycle, which is from FY13 to FY23, where we are right now, they have deleveraged, which means they have commenced the new capacities, they made money from it, and they have started paying off the debt that they took for putting up these capacities. Right? Once this capex cycle turns, HDFC Bank will start growing again. The next set of champs within our portfolio is the IT companies. IT companies' growth is linked to world IT spending. In another way, you can also say that if US inflation is very high, and in particular, US wage inflation is very high, the growth in the appraisal, the growth in the salaries that US companies pay for the employees, if it's on a higher side, then they look to outsource to a low cost country like India, which is where these IT companies come in. And right from 2005, Indian IT's market share has been consistently increasing. From almost 3%, we are at almost 13% now. That's the growth that Indian IT companies have had over the other IT companies. So they've been gaining larger market share from the US, UK, Europe's IT spending. Again, so we spoke about IT weights of Nifty 50 in the initial slides. Now, this is specific to Indian IT sector's weight within Nifty 50. If you see this, it's almost like a sine curve. At the bottom, it's 11%, 11, 12%. At the peak, it's 18, 19%. That's been the IT's sector's weight within Nifty 50. So everybody were bullish post-COVID in IT because everything was getting digital. Even the platform we are on right now, Microsoft Teams, contributed to this digitalization theme to some extent, right? So everybody was gung-ho on IT in 2021, 22, but that wasn't the time to be buying IT. The time to be buying IT is now when IT sector's weight has gone below its long-term average of 14%. I mean, even within that, so we have seen cycles, and there are cycles within cycles. Like in IT sector, should you go out and buy all the IT companies, or should you buy specific companies? We look at it. So TCS is our one of the top IT bets in the sector, and in the last since IPO, that is they IPO'd around 2004-5. Since then, they've compounded their free cash flow generated has compounded at a rate of 20%. So ideally, you should be overweight on a company like TCS because it's a beautiful company. They don't require capital. They generate a lot of capital that they pay out as dividends. The next company in our IT sector is HCL Tech. If you notice, so there was something has changed in 2021, 2022. HCL Tech had decided to increase their payout, dividend payout to 85% of their profits. So whenever they make 100 rupees in a year, they'll pay out 85 rupees as dividends. So dividend yield is the dividend amount you receive divided by the share price of the company. So when we bought HCL Tech in 2022, September 2022, it was trading at a dividend yield of 4.8%, right? At that point, it was higher than your savings and even some banks' FD rates. So that's how high the dividend yield was HCL Tech was for trading at. And since then, if you compare the performance of, say, HCL Tech versus Infosys, you can see the large underperformance between the two companies. So, should you have bought HCL Tech or should you have bought Infosys when Nifty IT's weight in Nifty 50 started falling? Of course, in hindsight, it's HCL Tech. We anticipated this to happen because of certain changes in the companies, in both these companies, because Infosys in 2021, 2022 was the consensus trade. Like everybody was buying Infosys. And the premium, the multiples that were assigned to Infosys had shot up even as much as TCS. It matched TCS multiples. So we felt that there is some premium built into the valuation. That's why we went and bought HCL Tech. Also, there are other reasons, but we'll not get there. So we were looking at cycles throughout this presentation, and even outside of cycles, there could be issues where a company stock is down for various other reasons outside of these cycles. For example, ITC. Right in 2021-22, everyone was talking about ESG, sustainability, right, environment, smoking is bad, and so on and so forth. So that was the narrative. But what did the fundamentals do? If you look at the sales or if you look at the profits or if you look at the free cash flow, ITC has been consistently growing in the last decade. So there was no point for ITC stock to underperform the market, which is where we were buying. The brown zone is where we were buying ITC, and you can see the stock price performance. We are still holding, and as of today, the stock is trading above 400 level. So we were buying at 200. The stock is currently trading at 400. Right. So that's how even outside of cycles, you can identify companies, why they're underperforming. Is it fundamental reason or is it reasons beyond the company's controllable? So Trublu as a product, who does it suit or who should invest in a product like Trublu? If you're new to market, if you're first time investors, this is definitely the product that will help you start building your wealth. And if you're close to retirement or if you've already retired, then if you want to protect your capital, then this is the go-to product. For ultra HNIs, for family offices and for institutions, for True Blue enables you to compound wealth at a very safe pace and risk-free manner compared to the entire market. So why should you own True Blue? If you're looking for a resilient, high-quality portfolio, that should be part of your core wealth chest, right? A True Blue fact sheet. So we've already seen our top 10 stocks. The most important aspect in the fact sheet is the beta. Beta is nothing but how risky you are compared to the market. In our case, Nifty 50, right? Our beta is 0.73, which means our products or our portfolio's risk is 27% lower than that of Nifty 50. So we have the same stocks, but we are taking lesser weight in terms of allocating more or allocating less or not having certain stocks. That's how we manage risk. So this is the output of our risk management. Investment team, the founder and fund manager, Mr. Sham Shekhar, he has 3 decades of experience, and the fund has a co-fund manager, Mr. G.R. Balaji. He has 17 years of experience. And this is the entire team at ithought managing 4 different products: Solitaire, Trublu, Vriddhi, and Spear. And I'm part of the research team. And we also have a strategy team, investment managers, and product managers. Uh, Portfolio performance of Trublu. So it's the product is 2 years old. We started in March 2021. So this is not really the right time period to measure a fund's performance because, like I already said, we are talking about 7-year cycles, 8-year cycles. But if you look at the 6 months and 1 year performance, we have an alpha of almost 3.5 to 4% over Nifty 50. And I think this gap can be maintained because the way we construct our portfolio, the way we allocate weights to each individual stock within the portfolio, and that's how the alpha is generated. Key terms for Nifty 50 and for our Nifty 50 is our benchmark for our product. The minimum investment will be 50 lakhs. This is SEBI mandated. We don't have any exit load. You have 2 options for fees. One is zero fixed fee. It will be completely linked to the performance of the portfolio. And another option is your traditional fixed fee, which is 1% for Trublu. All other expenses at actuals. So we have reached the end of the presentation. We wish you happy investing going forward. If you have any questions, we'll take it up. Please drop your questions in the chat window.
Good evening, everyone. Thank you for joining us today. Thank you, Sanjay. It was a great presentation. And I think there's a question from Mr. Roshan. Hi, we can get a recorded version of the session, please. Sir, one of our representatives will get in touch with you after this meeting to share a recorded version of this session because it's already live on YouTube, and we will share the link as soon as this session is complete. Thank you. Yes, Sanjay, you can take this from here.
Yeah. So there's a question from RP. Can you share your hedging strategy a bit? Said I didn't understand your question. So we don't hedge anything. This is pure 100% long only equity fund. So we don't hedge in Trublu. So the next question from Harish Chandramouli. The names of the companies from 1 to 10 were mentioned, while number 11 to 20 were not shared. Sir, we can't reveal the entire portfolio because that's where our thinking comes in. That's our intellectual property where we can't reveal the complete portfolio. The top 10, as a mandate, we share a fact sheet, which will have the top 10 stocks. Even we don't even give out the weights of each of these stocks. That's because that's where our discretion comes in. That's what differentiates us from Nifty 50 or any other fund for that matter. If Trublu return only up to Nifty 50 index, what is the catch to go with it? Sir, the question is very valid, and that's why I had mentioned about beta, which is the risk you're taking in your portfolio. Our beta compared to the market is 0.73, which means we are taking 27% less risk compared to the index. That's where we try to manage risk. We don't take high leverage. not just leverage, we don't even have companies which have very high earnings volatility. I mean, if you we can't hold stocks where your profitability will have a degrowth, right? One year they did 100 rupees earnings and the next year they do 90 rupees. So that kind of volatility, market doesn't give much multiple to those kind of stocks. And the earnings are very cyclical in certain sectors, which we try to avoid completely. And that's why our beta is very low at 0.73. Hi, sir. What's your perspective on EV industry? So EV is a compliance thing, is turning out to be a compliance thing for most of the governments, right? They're all mandating net zero goals by 2000. They have certain goals for 2030. Most of the countries are looking to go net zero in terms of carbon emissions by 2050. So that's where the mandate is coming from. And we are also seeing the penetration of EV going from low single digits to high single digits in FY23, and this will continue to go up. And this is very broad when we look at EV industry because there is two-wheeler, there's four-wheeler, and there is commercial vehicles. So the penetration will differ for each of these segments, and we are rightly positioned in our portfolio in few of the stocks for to target this EV transition from IC engine to EV vehicles. If the alpha is small, like 1 to 3% after charges, it will not be attractive, I'm afraid to say. Sir, the returns that we showed you is after all the charges and tax and fees. It's net of all these costs. This is what you get at your end. And in addition to that, this is just 1 year, 6 month performance. I think we should judge a portfolio or a fund from a 3 to 5 year perspective. So the 1% is fixed fee, rest are all on actual basis. The transaction tax, the GST, all of that will be based on the government mandates. We don't decide that, it's already mandated by SEBI and government. You will have that in any kind of investment, not just a PMS product.
Sanjay, I'll take that question.
Yeah.
The brokerage rate. Yeah, the brokerage rate that we've fixed with our partners, trading partners, is at 0.10% per trade, sir. So whether it's buy or sell, it's at 0.1% per trade. That's our brokerage rate, which is our which is with our which is at a discounted rate with our trading partners. Hope that answers your question, sir. So if you look at the overall charges, right, like Sanjay had mentioned, if you take into consideration the SCT, transaction charges, audit charges, and any other charges which is on actuals, it will be close to 0.2 to 0.3%, right, which you would be incurring on the portfolio on a case-to-case basis. That is, this will be the average. I hope that answers your question, sir. Yes, sir. So one more thing I would like to add on this is, as Sanjay had mentioned, we run a very low churn model, and your transaction costs are going to be minimal because there's not going to be a lot of buying and selling. What we do is we buy and hold them until the valuations become unfavorable in terms of the upside, and then that's when we take a sell call. So you're not going to have a lot of activity. It's going to be towards productivity that we actually look forward to, and not activity on your portfolio. So you'll have ideally a low transaction portfolio. So your actuals would be in tandem with that. Sanjay, I'll take that question as well. I have recently taken up PMS with iDirect. Can I add another now? That's not a problem, sir. You can add how many ever PMSs that you want. So it's going to be PMS is a structure where you just add another demat account to your existing NSDL or CDSL account, and there's no limit to that. You can add as many PMSs that you want. Thank you, sir. Sanjay, there's another question from Mr. Harish. Do you share regular valuation updates for the shares to the investor?
No, sir, we don't share valuation updates. We give out a quarterly letter from the fund manager. Every quarter, we will receive a letter from the fund manager, which will list out any changes that we have done to the portfolio or why we are making certain changes, what's happening in the economy, and how it will impact the stocks in our portfolio. So you'll get a qualitative update from us rather than a quantitative update, which will list the PAT or the financials or the valuations. You can find it in public websites like Screener, the valuation of these or the financials of these stocks. But we will give you a quarterly qualitative update of our portfolio and what is our thinking behind our portfolio construction. Do you have any other products like PMS because ticket size is high? Yes, so we do have mutual fund distribution and RIA, which is advisory. We'll ask our team to get in touch with you. Of course, so we evaluate each of the investors' clients' portfolios on a regular basis, on a daily basis too. And if we think that there's a certain stock which is come into our valuation levels, like for example, I've explained the HCL Tech's investment that we did when it was trading at a dividend yield of 4.8%. So we reached out to all our existing clients asking for more money to be invested in HCL Tech. So that's how our process is. We continuously evaluate the valuation, we continuously evaluate the stocks and which part of the cycle each of them are in. And then we regularly, frequently contact clients for additional money if there are any opportunities available. So we can't even view our demat account portfolio, but other PMS they provide view only account. So you will get a monthly update from us, which will list the portfolio and how it is performed, what is the weight of each of these stocks in your portfolio. That will be a monthly update. Even otherwise, you can sign into your demat account, be it CDSL or the other one. So where you will see the holdings that you have across your across PMSs, across your personal trading accounts as well. Outside of that, we give a monthly update of what your portfolio is. And not just that, if you feel that you want to talk about a particular stock, a particular event, or how it will impact your portfolio, you can reach out to us. We can set up a call. We can discuss your queries and doubts anytime you want. Thank you, sir. So this is purely a large cap product, Trublu, where the benchmark is Nifty 50. So all the stocks in the portfolio will be part of Nifty 50. It will not be Nifty 100 or it will not be Nifty 500. We have other PMS products which focus on different sectors of the market. What are the other plans you have? Trublu is large cap only. Yes, sir. Trublu is purely a large cap fund. We have three other funds, which is Solitaire. Solitaire is our flagship fund. It is a multi-cap fund, which means we are market cap agnostic. We invest across large cap, mid cap, small cap. We also have Vriddhi, which is more of a small cap only. We also have few mid caps there, but it's predominantly a small cap PMS product. We have Spear, which is our fourth product, which is multi-asset. It's not just limited to equity. We also invest in other asset classes in Spear. So that's the four products that we have in our ecosystem. So how different is the product from a focused mutual fund? Let's say you give a money to a mutual fund, you will get the existing weight of the entire mutual fund of all the aggregate funds of that particular product, right? But in case of a PMS, it will be very specialized. It will be bespoke. It will be customized for you, right? If you give in money, let's say you gave 50 lakhs initial corpus to us to manage, and then let's say a few quarters, a few months later, like right now, Infosys has fallen post very bad earnings, right? So then we'll reach out to you asking specifically money for buying Infosys, right? But in case of a mutual fund, you can't make use of these falls because your money, that the incremental money that you give will be spread across the 20, 50, 30 odd stocks that the mutual fund will have. So you don't get that specialized portfolio customized for you in a mutual fund. That experience you'll get only in a PMS product. If one wants to invest in other plans also along with large cap, one need another 50L. Yes, sir. So any PMS product, any new PMS account, SEBI mandated minimum amount is 50 lakhs. The incremental amounts could be 1 lakh, 2 lakh. That's up to your discretion. But the initial amount has to be 50 lakhs as mandated by SEBI. My query is whether this first 50 lakhs can be divided in other plan also. No, sir. So each plan you'll have to invest a minimum of 50 lakhs to begin with. How about the blue chip funds in M2W? We can continue to invest. Yes, sir, we can. You can continue to invest. We'll ask our advisor to get in touch with you to take this further. Ganesh, you'll take that. How many investors are with Trublu?
We have close to 22 investors who are part of Trublu right now, sir, as of now, as of today.
22 investors, and AUM that we manage is close to 35
33
crores.
to 34. Yes, yes, yes. And we have a mix of family offices. So, like Sanjay had mentioned in one of the slides, right? What kind of investor should look at a product like Trublu? It's predominantly we have big family offices investing a huge chunk of money where they have a specific requirement with respect to risk management, right? Because what we tackle with a Trublu in a very efficient way is the risk. The risk management is specifically given a lot of emphasis to in our Trublu product, and that is what these family offices tend to look for. And so it's a good mix of these retail investors and family offices that put together this overall area. So, hope that answers your question.
What is M2W? So M2W is our new initiative, sir. Milestones to Wealth. The short form is M2W. Say an investor doesn't have 50 lakhs to invest in a PMS product, and they'll have monthly salary income, so their entire corpus will not be more than few lakhs. For them, we customize mutual fund strategy or equity advisory to start putting in SIPs, SIPs every month, and we help them reach their milestones. Let's say a corpus is 1 lakhs today, and how can we get them to 5 lakhs corpus? Or let's say we are beginning at 10 lakhs today. An investor has 10 lakhs investments. So how can we take it to 50 lakhs? So we do it based on milestones that the client wants, and we help them invest accordingly so that they can build their wealth to reach those milestones.
And just a small correction, Sanjay. The
Yeah.
previous answer is 32 investors, not 22. It's my bad. Apologies. It's 32 investors that we have, sir, with Trublu, right? As of now.
Yes, sir. M2W is advisory and not PMS. Large caps, especially Nifty 50, is near to all-time high. How to manage risk and rebalance your portfolio? Sir, I don't find the need to rebalance the portfolio just because Nifty 50 is at all-time high, because we are in the middle of a cycle. So we saw the Nifty 50 components weight. No particular sector is near to its peak weights, or if you look at it from a point of view of capital cycle, all the corporates have deleveraged. They're not carrying any risk on their balance sheet like they used to in the peak of the previous cycle. So we are not near to peak in terms of balance sheet, in terms of leverage, in terms of profitability, in terms of sectoral weights, or even in terms of valuation. So we are somewhere in the middle of the cycle. So we don't find the need to rebalance the portfolio. How do we manage risk? We manage risk by sticking to the valuation levels that we prefer. Like we didn't buy Infosys, we bought HCL Tech, but now you see the difference in performance of HCL Tech has gone up almost 30%, 35%, and whereas Infi is down 5%. Now we'll start buying Infosys and not HCL Tech. So that's how we manage risk, and we continuously evaluate all the stocks based on what will be their IRR for the next 3 years, next 5 years, which part of cycle they are in, and that's how we evaluate and keep adjusting or managing risk. What will be your average return in this PMS? Actually, how many years will it take to double it? So the average return of the entire fund in the last 1 year was 16%, and it will be very difficult for us to say how many years it will take to double your portfolio. Nifty 50 long term has compounded at a rate of 12 to 13%. We endeavor to make alpha more than this 12 to 13%. So it is very difficult to pinpoint accurately as to and say as to how many years it will take to double your portfolio. Will 50 lakh get invested immediately or in a staggered manner like STP from liquid fund? No, sir, it will not get invested immediately. Depending on where we are in the cycle and what kind of valuations the companies are at, we'll decide the investment deployment strategy. And it could be 50%, 60%, 65% at max. So we don't deploy it in one go. It will at least take us few months to completely deploy this 100% of your corpus. So it will be in a staggered manner based on the valuations and valuation of stocks, the sector, and the fundamentals of which part of business cycle each of these stocks are in. Yes, until the amount is being deployed, it will stay in liquid or cash. So how many persons are usually allocated for one PMS product for analysis or fund management? So the research team consists of 5 analysts, and then there are fund managers above who will take the final decision, but the analysis is done by the 5 research analyst team. And we also have a separate investment strategy team which looks after Spear PMS, which is a multi-asset product. So that demands a different set of skill sets. So that's how we have differentiated equity research and multi-asset research. And each product will have a separate fund manager. And another differentiating uh, aspect for us compared to other PMS or mutual funds is everyone will have a big sales team, whereas it's the opposite for us. Our research team and the fund managers put together, we're almost 12 to 14 in number. Our sales team will also will be of a similar number. So we are heavy on research, and that drives our philosophy. Let's say the returns of the fund is 16%. Can I know after exclusion of the expenses and fees, the actual returns for the investor? Sir, the fund return of 16% is net of all the expenses and fees. So only tax is not included in this. That will be at your end. It can be a PMS or mutual fund or any product. So the returns that we have shown is after all the fees, charges, and our fees. Feel free to ask questions. If there are any more, please drop your questions in the chat box. We'll give it a minute before. Yeah, we have another question. I have some investment products abroad. I'm not sure if it would be a good decision to sell them, invest in this PMS product. So we can take this offline post this meeting, so we can discuss your investments. We'll set up an investment review meeting for you. Our team will get in touch with you post this meeting, sir. Yes, sir. We'll definitely have an investment review meeting with you.
Yeah, I'll take this question, Sanjay. Does PMS returns come under the CG tax or any other specific taxation applied for it? No, sir, it comes under the CG tax only. So PMS is only a structure where you grant the PMS manager a power of attorney to execute transactions on your behalf. So it's like you transacting with your own demat and trading account, right? So which your capital gains, whether it's long term or short term, will apply. Same thing would apply to your PMS returns as well. So the returns, when we mean returns, it is on the realized returns. So hope that answers your question, sir. Thank you, sir.
We'll wrap it up, Ganesh.
Yeah, sure, Sanjay.
Uh, there's another question. So whether there would be plan to exit in some stocks when they're overvalued? Yes, sir. So valuation alone doesn't decide if we have to exit a stock completely. So in those cases, we'll trim the stock. Let's say we started a stock at 5% weight, and some stocks have doubled for us. So and the stock weight would have gone to 10% on actual basis, right? So in those cases, we'll trim as in we'll sell some quantity to bring it down or manage to a manageable weight that we think is right for that stock. So we do act, but we don't completely exit just on the basis of overvaluation. Hope that answers your question. So thank you, everyone. Thanks for the questions. And if you have any more questions, do reach out to us. We can drop us a mail anytime you want post this meeting. So we'll get in touch with you. Our advisors will get in touch with you regarding your specific questions that you asked. So thank you, everyone.
Thanks,
Thank you,
everyone.
Mr.
Thank you
Sanjay.
for, yeah, thanks. Sorry, Tarun. Yeah,
Thank you,
thanks,
Mr.
Sanjay.
Ganesh. Thank you. Hope you all had a great session. I'll be posting the email ID as well as the phone number on the chat board. So in case of any queries, you can contact us. Thank you.